Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within corporate filings. Today we're diving deep into Nuburu Inc.'s registration statement on Form S-1, and believe me, this filing is a wild ride with more twists and turns than a roller coaster. So what exactly are we looking at here? This is a registration statement for Nuburu Inc., a company looking to sell up to 30 million shares of its common stock. Think of it as the official announcement that they're ready for more investors to potentially buy into their company, though it's not them selling the shares this time, it's someone else selling shares they already own. Nuburu Inc. is the company we're focusing on. This filing tells us a lot about their recent financial dealings, their challenges, and their plans for the future. They've been through a lot recently, and this document lays it all out. Now you might see some registration numbers and official stuff, but what really matters is the story behind it. This company has been hustling to stay afloat and make big moves. This filing is dated late August 2025, so it reflects the company's situation right up to that point. And this is a preliminary prospectus, meaning it's a draft and not the final version, so things could still change a bit. The big headline here is that up to 30 million shares of their common stock could be resold by someone called YA2 PN Ltd. This is a standby equity purchase agreement, a fancy way of saying they have a deal to sell shares if they need cash. They aren't getting money from these resales, though they might get money if they decide to sell shares to this same company beforehand. Nuburu was originally known as Tailwind Acquisition Corp., a special company formed to merge with another business. They merged with Legacy Nuburu back in January 2023 and then changed their name to Nuburu Inc. This section is super important. It's a deal where Nuburu can sell shares to YI2PN Ltd if they need cash up to $100 million. They can do this over 36 months, but they don't have to sell any shares if they don't want to. They've already sold over 12 million shares under this, and now they're registering more. This is a key point for anyone thinking about buying into this offering, because Nuburu controls when they sell shares to this company, and that company can sell them later. Investors might buy in at very different prices, leading to different outcomes. It also means more selling pressure might hit the stock price. This tells us Nuburu is juggling a lot of different financial maneuvers at once. This can be a sign of financial stress, but also a sign of actively trying to fix things. It also means more shares could flood the market, potentially driving the price down. And then we hit the risk factors buckle up because it's a long list. It's not possible to predict the actual number of shares we will sell under the CPR to the selling stockholder or the actual gross proceeds resulting from those sales. This highlights the uncertainty in the entire plan. This is about as straightforward as it gets. They've lost a lot of money and profitability is not guaranteed. As of last year, they had an accumulated deficit of over $130 million, and even in the first half of 2025, they lost another $28 million. This is serious stuff. This is the classic lifeblood warning for any company burning through cash. They need more money, and if they can't get it on good terms, it's game over. They mention needing money for acquisitions too, which can be a risky strategy. This means it takes a long time from when they first talk to a customer to when they actually get paid. That means a lot of upfront costs without immediate revenue, which is tough on cash flow. This is a big red flag. They are not currently meeting the requirements to be listed on the stock exchange. While they have a plan to fix this, it's a serious concern that could drastically affect their stock price and how easily people can buy or sell it. This is a massive red flag for investors. Restating financials and finding material weaknesses means their past accounting wasn't reliable and they might not have proper systems in place to prevent errors. It shakes investor confidence. This is a bit of jargon, but it essentially means if directors or officers get sued and have to pay out, the company might have to foot the bill through these indemnification agreements, which impacts shareholder value. Let's circle back to that standby equity deal. It's essentially a lifeline, but a potentially dilutive one. They can sell shares at a discount to market price to get cash. This means the selling stockholder has a lot of control over how many shares hit the market and when potentially impacting the stock price. Crucially, the company itself isn't making money from the shares being sold by the stockholder in this specific offering. Now let's look at some numbers. If they sell shares at just HO's 0 times $3.23, that's the closing price on August 20th, 2025. They'd only get about $4.7 million for 30 million shares. That's not a lot of cash for Sony shares, and it doesn't help them much towards their $100 million overall goal from this agreement. Even at $1 a share, they barely raised $29 million. That doesn't sound like much for a company that needs so much capital. This section outlines their core business shifting from laser technology to acquiring other companies. They had a deal to acquire a defense tech company called Technair and a software company. This is where they admit they have a serious cash problem. They've had to furlough employees and some have left. They're facing considerable doubt about their ability to continue as a going concern, which is as close to saying we might go bankrupt as you can get in a filing. This is a massive event. They lost their patent portfolio because they couldn't pay their debts. That's a huge blow to a technology company. Here we see the raw numbers. Revenue is down drastically from over 2 million in 2001-23 to just 152,000 in 2024. Their net loss for 2024 was over $34 million. The revenue drop is steep and directly linked to the cost-cutting measures and furloughs they implemented. While expenses have come down, they are still high compared to revenue and the company is still operating at a huge loss. Their general and administrative expenses are particularly high. Let's look at EBITDA, a measure of profitability before interest, taxes, depreciation and amortization. It's negative over 30 million for 2024. This shows the core business is losing a lot of money. Free cash flow is also negative. This means they are spending more cash than they are generating from their operations, which is why they need constant financing. This is where the auditors weigh in. They give a clean opinion, meaning the financial statements are prepared correctly according to accounting rules. But they also highlight the huge going concern doubt. This means there's a real question about whether the company can survive. They also mention restatements, which means past financials were incorrect. Looking at the balance sheet as of December 31, 2024, we see total assets of about $7 million, but liabilities of nearly $21 million. That's a stark negative equity situation. Their cash is also very low, only about $200,000. This number is a really important one. It represents the total net losses the company has accumulated since its start. As of December 31, 2024, it's over 150 million. This shows a consistent inability to make money. Here we see the income statement. The revenue decline is dramatic and the net loss is substantial year after year. This is where the nitty-gritty details are. They explain the restatement of their 2023 financials and a whole bunch of new debt and agreements. It's clear the company is constantly making deals just to keep operations going. This goes into more detail about that standby equity deal. It is accounted for as a liability because of that embedded put option. This means its value can change and impact their books significantly. They've also paid $1 million in stock just for this commitment, which is a hefty upfront cost. And here's a look at their preferred stock. It ranks higher than common stock, meaning preferred shareholders get paid first if anything goes wrong. On January 31, 2025, due to certain conditions, they were obligated to redeem this stock, which is a massive cash outflow if they had the money. So what's the story here? Nuburu Inc. is in a very precarious position. They've pivoted their business multiple times and are now heavily relying on complex financing deals and potential acquisitions just to stay afloat. The loss of their patent portfolio is a devastating blow to their original business model, and the constant need for capital, even through dilutive equity offers, is a major concern. While they have a plan and are making moves like acquisitions, these still carry significant execution risk and are facing delisting from the NYSE, adds further layers of risk for any potential investor. We're invested in bogging the financial numbers paint a picture of a company struggling to find profitability with a history of significant losses. And mounting debt, the fact that they've had to restate financials and are facing delisting from the NYSE, adds further layers of risk for any potential investor from the NYSE. Adds further layers of risk for any potential investors and are facing delisting from the NYS. Adds further layers of risk for the company direction shows a desperate attempt to diversify and survive by leaning heavily on new acquisitions and financing. While this could be a path to future success, it's extremely high risk right now given their liquidity situation and past performance. The notable risks are their ability to execute these acquisitions, raise sufficient capital and turn a profit before they run out of money. In conclusion, Nuburu is a high-risk, high-reward scenario, but right now the risks seem significantly higher than the potential rewards. They are walking a very fine line and navigating a complex financial landscape. That's our deep dive into Nuburu's latest filing. What do you think about their strategy and their chances of success? Let us know in the comments below. If you found this analysis helpful, please hit that like button. It really helps our channel. And of course, subscribe for more corporate breakdowns. Don't forget to join our Discord community, linked in the description for more discussions. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.